Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at ODNA, and I'm joined again this week by my colleague, good friend, Bram Gallagher. Bram, welcome back.
Thanks for having me on again, Jamie. Always a fun time.
So we chatted, I guess it was a week or two ago now, about the outlook for 2026 and sort of the assumptions that were in there. And now we're here to talk about November, which was an interesting month. We also got a lot of new economic data. So we have maybe a better sense of, or at least a interim sense now, since we went a couple months without any employment or CPI data. And we also have a whole lot more sort of bookings that have happened for the World Cup, getting a sense of how 26 is actually pacing. So love to dive into all those things with you. How does it sound?
Sounds great.
Awesome. So maybe we could start with just a quick rundown with how performance for the U.S. Ended up in November. So it wasn't a great month. Overall, RevPAR was down 1.1%, and listing growth was pretty strong. Demand seems like the story though is like on demand growth. Like demand was only up 1.4%. Occupancy was down 2.6%. ADRs were only up 1.6%. So, Bram, what do you think was going on in November?
Well, we have seen a bit of weakening performance as the year has gone on. We started really strong with big demand gains in January this year, but that has slowly sort of eroded over time. We had a little bit of a weaker, softer summer than maybe we would have expected, but definitely it definitely weakened a little bit more in November as far as on the demand side. But one of the interesting things about that was I was looking at the charts, the pacing charts, and I noticed that wow, it seems like a very slow sort of demand growth number at about 1.5. So certainly slower than last month, which was around 2.6. And it seemed like every single day in the month was doing better than the month as a whole. So it was just like we had talked about earlier. We had noticed that there was a Friday that went out of November this year, and it got replaced by a Sunday. Normally, these kind of calendar shifts aren't a really big concern, but once we start getting down to, I guess, these single-digit growth numbers, and also the fact that it was a really poor Sunday that we picked up and a pretty strong Friday that we lost, that actually shifted materially the monthly performance. If I was to shift it just one day, for example, so that we would have the same days of the week as last year, we'd be moving out from, say, 1.4, 1.5 demand growth to around 2.7, which is slightly faster than October. So, it does get a bit tricky. I remember when we used to sort of do this with hotel and supply data, and STR would always take out the leap day, because that would be enough to sort of throw our calculations off. This is kind of a similar sort of calendar shift, I guess. It seems like only a small difference, but it does sort of materially reflect on the month as a whole when we get to these sort of growth rates.
Yeah. So, and it looks like the day of week shift impacted about 1% in terms of overall percent and a half in terms of overall occupancy change.
Right. And I would say even without the calendar shift, occupancy was a bit lower than it was last year, but it was really right on with 2023. If we looked historically, December of 2023 had a higher occupancy than 2024. So not exactly sure where we're going to end up, which year we're going to cling to the closest for December. But in any case, it's not a huge difference. Moreover, when we look at the sort of year-to-date occupancy, we are now neck and neck with 2024 for the year. So if we do want to have any sort of occupancy growth, then we're holding out hopes for a strong December and good holiday performance. One bright spot, though, I thought was the ADR. Now 1.7 1.6 doesn't sound like a whole lot of growth, but it was this summer we had very weak, almost flat ADR growth and repeat rent index growth as well. In fact, in September, ADRs declined by as much as 2.2% year over year. So I am happy and gratified to see both the repeat rent index and also ADR return to growth for now 2 months in a row, October and November, seeing positive rate growth. And in fact, our repeat rent index is even gaining a little bit of momentum. So it's now increasing or accelerating its growth rate now for the second month in a row. So that was nice to see.
Yep. So, do you have any positives for me? And besides rate growth, like were there any market types, location types, chain scales, that price tiers that saw any increases in occupancy, or was it down sort of across the board?
It really was a down across the board. So maybe that calendar shift did have a lot to do with it. It did affect all of those locations sort of equally. All the location types posted occupancy declines about between 2 and 4%. The largest hit was mid-sized city, but it wasn't by very much. It was down 4.2%. But even small city rural, which had a really large sort of demand, relatively large demand growth of around 4.6%, even it saw declining occupancy as its available listing nights growth has been very, very strong, and it has been for at least the last few years.
Yeah. No, I was looking through your sort of top markets chart, and this is available in the report, which will be linked in the show notes. I was surprised. I'm surprised is maybe a strong word. It was interesting to see the top three markets in terms of occupancy and RevPAR change. We're all in the Bay Area, so San Francisco, San Jose, Palo Alto, and Oakland. And then I was listening to our friends, STR, Jan and Isaac, talking about hotel performance for the month, and they called out that San Francisco was their top RevPAR growth market, and there's a lot of sort of tailwinds with travel finally coming back to the Bay Area, San Francisco, and that it's this year consistently been one of their top growth markets. We're not seeing nearly the growth that they're seeing. I think November RevPAR growth in San Francisco about was over 20%, but strong growth nonetheless.
Yeah, and I had sort of attributed that to the strong performance I've seen in San Francisco and the entire Bay Area. I had attributed some of that to it's a difficult sort of regulatory environment to establish new short-term rentals. So the existing sort of stock, I guess, is protected from ruinous competition to some extent. So definitely have seen performance boosts, including that really big 8% occupancy growth that we've seen this last month in San Francisco. But of course, also the Bay Area getting a double whammy this year. They're going to get the Super Bowl as well as some World Cup games, so they're very excited about that. I think there's a lot of people preparing and trying to amp up their hospitality, I guess, offerings for those events. But yeah, good performance from the Bay Area, solid performance.
Yeah. So the other topic I wanted to get into before we start talking about some of the pacing data was economic data that we saw released over the past couple weeks. We did get a jobs report. We got 2 months of jobs reports on the establishment survey. Yeah, 2 months, two uh, pretty different months in terms of headline job growth. And then we just last week we got or this week got a measure of inflation, or last week. So maybe outline what did we learn, most importantly from those couple reports that we saw.
Well, the mystery deepens. We were sort of in the dark for a while because we just didn't have these reports, and now we've got them, and we sort of have to look into them pretty closely because there's some sort of there's I guess confounding factors that go on each with these, but they are consistent with the consensus expectation that the labor market is softening. Inflation remains a little bit hotter than we'd like, but it's not spiraling sort of drastically out of control. We've had a little bit of help from food and energy prices in that regard. sort of keeping that inflation anchored. But that sort of inflation report came out. One of the caveats to that is it was during the government shutdown, and there is a little bit of concern over the size of the sort of the survey, or the conditions under which the survey was conducted. So they're saying, well, take that with a grain of salt. Jerome Powell said, to keep that in mind moving forward. He's going to continue looking at the inflation rate and the jobs market as well. That has been sort of doing a zigzag motion, 1 month strong, the next month weak. We saw some pretty good numbers for November. Unemployment, however, ticked up just a little bit from where it was, to about 4.6%. But again, we got to take that with a grain of salt also, because the last 2 months we have seen increases in the labor force participation rate. So as we know, unemployment tracks the rate of people that are looking for jobs that can't find them. So rather than maybe a collapse in the number of jobs, this unemployment increase could signal just an increase in the number of people looking for them. But again, so neither one of these is really making big alarm bells ring in my head, nor are they really making me extremely confident moving forward that all of our economic woes are behind us. So once again, we're in this position where we want to collect more data before we can really make the sort of final pronouncements on where the interest rates are going to be headed, and exactly where sort of the economy is pointed to for 2026.
No, that makes sense. I was really interested to see where the accommodations employment ended up, uh, and with the additional 2 months of data, it's been something I've been watching very closely, because where overall U.S. employment has been up considerably in 2025, and through September, and last data points, we had essentially seen the accommodations industry as flat. So with the additional 2 months, and even for full year 2025, we see leisure and hospitality employment up 115,000 jobs. But then when you go in and look at and all the subcomponents, accommodation is actually pretty significantly down now, down 21,000 jobs for full year 2025, where and food service drinking places up 116,000, arts and entertainment, recreation up 20,000. So really the anomaly in terms of the service industry, in terms of and seeing job losses this year, and really a lot, and we see it across professional business services, manufacturing, government now, all solidly down for the year, and looks like we can and slot in accommodation as a sector that realized pretty big job losses this year.
Right, and it's difficult to pinpoint exactly where what that means. We do know that hotel performance, it's been a bit softer than the short-term rental performance this year, and that could be a big cause of it. But the hotel industry has long been having difficulties with labor shortages and finding the people for these jobs. So that may also be another difficulty in hiring, is being able to find good fit for these positions.
And when you hear the unemployment rate now up at 4.6, where just at the beginning of the year we were at 4.0, in the beginning of last year at 3.7, and the year before that at 3.5, it does feel like we're going the wrong direction. Though you go back to our economics textbooks, and 4.6 and is still seems relatively low. So, and how are you feeling about the employment market? Like, is it tight? Has it loosened a bit? What are your sort of indications there on is it that and there's just not enough labor supply, or what?
Well, it's kind of like the housing market. It seems to be more or less frozen. I think, you've got a lot of firms that are not exactly sure what the labor force of the future looks like. We've heard a lot about the productivity gains or the changes to the labor force that might be brought about by, AI and various new technologies. And we're not really sure exactly what that looks like. So we haven't seen lots of layoffs and firings and a lot of movement there. And on the other hand, too, we haven't seen a lot of people trying to switch jobs. Now that can, definitely have effects on wage growth as well, because job movements are where we see the biggest wage growth often. So there is that, but also I think a lot of people right now on both sides, hiring and trying to be hired, are sort of in a wait and see kind of mode. I can also bring back up the I mean, we've had really low unemployment, but we were coming out of a once in a century pandemic that was, I guess, a special case. On the other hand, if I were to go back to that labor force participation rate, where it has increased recently as the unemployment ticked up, but it's still at about 62.5, which is that's sort of mid late 70s era. So some of that is aging demographics. As the baby boomers get a bit older, some of that is increase in youth unemployment, and some of that may be discouragement among people that are just dissatisfied with the job market as it stands and don't think that there's a great fit. So that 4.6 does sound low, but there are, I guess, some structural changes that make today's economy a little bit different than, say, the economy of the 90s.
Yep. That makes sense. And we also saw an update on from our data on an overall international inbound. We've seen some of that data recently in government releases as well, and it seems like more bad news there from both our data sets, where we're showing inbound international demand for US stays still down and 16% year over year, and where we've been on stays from Canada down 37%. And we look at and data for all travelers to the US, we still see those pretty down significantly. So, and is that something that we can just and chalk up to? And this is sentiment towards traveling to the US, and we just have to assume that that's going to continue? Or do you see any sort of reason to suspect that that might change?
Well, I haven't heard a whole lot about, policy changes from this administration to be more accommodating to international travelers as of late. Now, as we move into the next year, of course, more and more attention is going to be focused on the World Cup. And, that's a huge international event. And I think that the administration's stance on international travel, whether they soften some of the rhetoric that they've been saying, to accommodate the World Cup, could really have a really big change on attitudes. We have seen, travel from Canada. It's not as down as much as it used to be. On the other hand, of course, that was during sort of peak summer travel season as well, when we saw those negative 47% down. The lingering sort of international, I guess you could say, deficit of travel, it's a little bit concerning. I was happy when it declined a bit. We sort of narrowed it a little bit in October, but it sort of widened back out in November. Maybe with some of these high profile stories about social media vetting and that sort of thing by the administration. But I think there's opportunity here for a real policy shift, and I think that could meaningfully change the international outlook, particularly since the dollar continues to weaken against the euro, making the U.S. very affordable for international travelers. And it's also, I think, diverting some domestic travel to the United States as well. So people that might have traveled to Europe, just seeing those price tags, getting a little bit of sticker shock, and deciding to maybe do a drive to leisure market within the U.S. as well.
Yeah, that makes sense. So we've talked, I think, last month about holiday pacing and how, again, we've got some calendar shifts helping maybe a bit versus last year. So for those sort of paying attention to the calendar, we have Christmas Day and New Year's Day this year falling on a Thursday versus last year where it fell on a Wednesday. And it does at least seem like it would be a bit easier for people to make a a long weekend out of it if they only have and maybe 2 or 3 days that they can take off. So, what are we seeing now that the holidays are imminently upon us? This podcast is probably coming out on Christmas Day. What are we seeing?
Well, yeah, to your point, I mean, it is now December 22nd when we're recording this. I think last year we probably would have both taken Monday off because Christmas Eve would have been the following day. So, we're kind of maybe pushing some of our plans just a couple days into the future. And so December pacing right now, and you're right, this has been a year of calendar shifts for sure. But December is pacing right now around 4%, which is certainly better than the November demand growth. And even with the calendar shifts that we talked about earlier in November with the Sunday, Friday, 4% still higher than that. However, what we are seeing right now is that a lot of that holiday growth is going to be centered right here on actually New Year's Day on January 1st. So it's going to be pushed into the next year, but we're seeing an enormous increase in the pace around there, around 38% as of the end of November. So I think you're right. People's plans, I think, are much, much different this year than they were last year. We're planning that long weekend on New Year's this year. It's going to push some of that performance into January, and that's why we see the January number is jumping up even higher than 4%. It's up 7.2. The Christmas holiday as well. I think it's going to be pretty big. We've got boosts there around 8% as well for the end of this week. But it's that New Year's, I think, that just pushing it just a couple extra days later is really causing this giant performance spike here. But in any case, I'm pretty positive about holiday performance. I think everybody is ready to take a little travel trip, whether it be on New Year's or for visiting family, friends on Christmas. Or even getting out, actually, because we've seen a holiday lift across all the location types. So not just the suburbs where you're going back to see the folks, but also coastal resorts, mountain lake resorts. So people are taking holiday vacations as well as visiting friends and family.
Yeah, and my anecdotal evidence of my own property, and we're using it for Christmas, but we're renting it out for New Year's. And we saw last year we got a 3-day booking. This year we actually had a 3-day booking. It got canceled and then immediately got replaced by a 6-day booking over New Year's. So I was pretty excited about the 3-day one, sort of linking on New Year's Eve through the weekend. But 6 days, someone really taking advantage of the super long weekend.
Yeah, no, that's incredible. Hopefully the hangovers won't be too bad on the following Monday, the 5th. But that's great news for that is great news for your mountain cabin.
Yeah. So maybe fast forwarding on the pacing data a bit, like looking further out, and how are we seeing pacing for 2026 play out right now?
Well, it's funny that you should mention that. So in the latest review, which is available now, if I'm not mistaken, but in the latest review, pacing looks pretty good. Now, on the other hand, I only go out 6 months when I do sort of my pacing reports. So that's December through May. We're seeing pretty good spring performance. March and April in particular, we're seeing a lot of interest there. May is a little bit softer. However, I missed sort of the short-term rental event, maybe that we've ever seen in history, which is coming out the very next month in June, and there we're seeing sort of explosive growth for the U.S. Now, not every U.S. City is going to be playing host to the World Cup, but it's enough right now. The bookings that we've seen over just the last few weeks is enough right now to be pushing that June into a really, really stellar spot, about 25% as far as the demand pacing goes. So, this time last year versus this year for June, up 25%. And that's pretty good because, we know that June, July, August, those summer months, they are the months that have the longest lead time as well. So, sometimes you can get with events and pacing, sometimes you get to a situation where there's a month or event that people are booking early for, and normally they would never book early. But when the summer months, we're talking about those, lots and lots of people do book early. So that 25% nationwide is pretty significant. It intensifies if we look just at the host cities, and these are some of our biggest markets, but those are up 158% in June. And that's when that first round of matches that has just been announced, those are going to be taking place. So saw incredible surge in interest in booking just in the last few weeks after the draw.
Yeah, that's incredible. I don't suspect you have it in front of you, but something we might want to start keeping tabs on is sort of summer pacing with and without those top World Cup markets that are going to be sort of really impacting and June and July performance.
Right. I wonder if there might be some diversion, right? So if you're a soccer fan, you're going to be wanting to go to the World Cup if you can, or even be in some of these cities. On the other hand, if you're going to take a holiday and you usually visit Miami for the beaches and the architecture, you might reconsider and choose a different spot. So there might be some sort of diversion, which could cause spillover benefits for the other markets as well. So definitely something to look at.
And then what I thought was super interesting too, digging into the World Cup data, our colleague Linda Rollins put together analysis of and all the games and which games saw the largest increases in bookings, which was a huge surprise for me, seeing the strong bookings from Scotland. So three of the most booked games over the past 2 weeks have been games including Scotland, so with Scotland versus Brazil in Miami drawing the most demand over that 2 week period, followed closely by Scotland versus Haiti and Scotland versus Morocco. So pretty exciting to see now which games are driving the most bookings. We still see Mexico versus Republic of South Africa still is the number one most booked game, but starting to see some disparities sort of show up across markets. So New York, New Jersey, Newark market seeing the most overall nights booked, but Vancouver, Kansas City, Monterey, even Boston seeing the strongest overall occupancy. So we're going to see some, I think, really big disparities among markets. A lot of that has to do with the not only the short-term rental inventory, but the hotel inventory that's available to accommodate guests in these markets. And then as we get closer, I suspect those high levels of occupancy will start impacting and how much additional supply is being added into these markets, and ultimately what the rate premiums a lot of hosts will be able to achieve for World Cup period. But it's going to be a something I suspect is going to be mentioned on probably every podcast till July as we get the lead up to the World Cup.
100%. I am most excited to see what those rate premiums end up being, because we've had a lot of talk about sort of affordability in the World Cup, and then of course the makeup of the guests that will be coming, the compression that may happen. So we've got tons and tons of factors going in. It's a little bit of an unknown. We've never seen an event quite like this in the U.S. So really excited to see that Brazil versus Scotland match, the bookings for that. I mean, Brazil is a huge team with a worldwide following. Scotland is extremely excited to be back at the World Cup and playing their old pals Brazil again. So yeah, I think it's some data that I'm really looking forward to seeing how it plays out and how it develops.
Yeah. So I know I've already got your prediction for 2026 in terms of short-term rental industry performance. Do you have a prediction yet on World Cup winner 2026?
World Cup, a winner, right? It's USA all the way, of course.
Love it. So Bram, wrapping up, any holiday plans?
Holiday plans. Yes, we are. We're going to be redoing the kitchen. We're installing some new cabinets there. So, really, really fun, exciting stuff. Really looking forward to it.
That does sound really exciting.
We know how to have a good time over the holiday break. I hope you really enjoy. You've got such a beautiful listing. That's going to be great on Christmas. I love all the memories that you guys are going to be developing there and all that. And you have some exciting plans for the new year as well, right?
Yeah, we're taking the boys down to Key West, down to the Keys after the New Year. So get some sun and sand. They don't go back to school till the following Tuesday, so we gotta come up with something to keep them busy. And there were some super cheap flights from Atlanta down to Miami for the period. So taking advantage of it, and hopefully it'll be a fun trip with the boys.
Yeah, New Year's with sun and surf. I love it.
Yeah. Well, Bram, thanks so much for joining and giving the quick overview of what we're seeing across the US over the previous month. And for all those listening, please check out the US review if you want to dig in deeper to the data, or check out your own market within the RDNA app. And we wish everyone a safe and happy holidays, Merry Christmas, Happy New Year, and we'll see you all in the new year.